organization works with what we call broad-based employee ownership because there's a lot of different kinds of ways employees can have some stake in the company, but our focus is on ways in which all full-time equivalent employees have a path to becoming a co-owner of the business. So the three main mechanisms that we work with are the worker cooperative, the employee stock ownership plan, and the employee ownership trust. The worker cooperative model is something where the ownership is direct by employees, so they participate in the governance directly and receive a share of the profit. Whereas the employee stock ownership plan tend to be a bit larger companies, and the ownership is actually through a qualified retirement plan with all the tax benefits and administrative complexities that come with that model, with the employees kind of as the beneficiaries of that plan. And with the employee ownership trust, the trust owns the shares for the benefit of the employees, but the shares stay in the trust. They aren't allocated to employees or held by them directly, with a wide variety of possibilities for the governance of the company. For worker co-ops, for someone to buy in, usually they work for a period of time, usually called a trial period, and then they purchase a single share of the company. And that share entitles them to a vote for a board of directors. For small companies, maybe under 10, usually all the owners serve on the board. For larger companies, it's elected and is a subset of the members, plus perhaps outside directors. And then a share of the profits on the basis of how much work each person contributed to the company that year. So that could be hours worked, their W-2 income, so high earners get a larger share of profit than lower earners. But a key thing that differentiates this from something like a simple partnership is that share price is fixed. So it's something where it might be, say, $5,000 to buy in after working for the company for 2 years. And then when the person leaves, the share price is bought back at a fixed value. So that $5,000 out. So when someone leaves, they get that share price back plus any of the profits that was retained in their name but not paid out in cash while they worked for the company. So, we've talked about the eligibility period. This is something that really depends on company, and I've seen anywhere from 6 months to 5 years that someone works for the company before they're eligible to become an owner. And so oftentimes that's kind of turnover based. Most companies tend to be in that 1 to 2 year range of long enough to be past the honeymoon period and have a clear sense that the person's a good fit and makes sense to be a co-owner of the business. That share price, you want it to be high enough that there's real commitment. People aren't going to walk away from it lightly, but not so high that those employees are not going to become part of the ownership because it's financially inaccessible. The role of the board of directors would be, approving membership applications, but they also oversee management. And then when profit is allocated to members, they receive it usually partially in cash, at least enough to cover their taxes they would owe that year. And then the remainder that can be held by the company as working capital is held in each member's name in what's called an internal capital account. When folks are thinking about an exit to a co-op, in general, first the owner does like a valuation and sort of explores and the model, tries to understand it, looks at the financial feasibility and says, okay, is there enough there, knowing what we know about the financing environment and everything else, that this would be a realistic thing for the employees to do. If so, then we move to the point of bringing the employees into the conversation, presenting the idea, presenting the model. And if there's that core group who's interested to form a group to represent the buy side of the transaction, the steering committee that might then eventually turn into the first board of directors, that group will do a couple of key things to explore this before deciding if they and the large employer group would like to do it. They will oftentimes start with this question of how are we going to own this together and work on the bylaws that define the kind of rules of the road for the group to own the business. And then we'll work with the business owner to review and update the business plan so they understand kind of what it is they're potentially proposing to buy in terms of, the condition of the business, how it makes money, what are possible opportunities, et cetera. The group and the owner, in oftentimes using a third-party valuation as a key element, will kind of agree on a price for the business. And then once that is kind of identified, that allows for the financial model to be refined and loan applications to go into specialized lenders and other things like that. And then hopefully the package that allows the group to have the money to buy the business, whether it includes seller financing and other sources, is secured, and it looks like, all right, there's a deal. Oftentimes the seller is going to have sort of, especially if they're going to be holding a seller's note, will have some concerns that need to be addressed. And that is oftentimes done through things like a covenant on the seller financing that says, okay, if the business owners wants to have, as long as the company owes them money, the ability to veto certain capital expenditures over a certain amount, or receive monthly or quarterly financial statements, or be able to sit in on board meetings or other things like that give them extra security during the transition while they're still on the hook for a portion of the company's value. Once those terms are all developed, the group will usually form an entity. So now they have something, rather than just being a group that's considering this, they have founding members numbers. They have a legal entity that can have a bank account, that can put in loan applications and all of those things, and hire a lawyer and then enter into the transaction process to actually purchase the business. And then once it's been purchased, depending on what the owner is looking for, if they're looking to retire, they might have a consulting contract for a period of time or be an employee of the company, helping with the sort of management and other transitions. Or we see plenty of examples where someone might be more mid-career and they're not looking to leave the company, but looking to sort of transition ownership of the company to this new model. And they can even become a co-owner under the new framework and participate and continue to lead the company for a period of time. Separating that management and leadership transition from the ownership transition can oftentimes be helpful in that you don't have two big stressful things happening at once. So when it comes to actually where does the money come from for these employees to buy the business, the member shares are usually a small percentage of the purchase price. Usually there's going to be some seller's note. The simplest deals are member shares plus seller financing and maybe a line of credit for working capital. In many cases, it's like, okay, seller might hold 25 or 50% of the sale price to be paid out over time. And then they get cash at closing from a loan. And there are several kind of co-op friendly loan funds. The one that we interact with in our region most commonly is called the Cooperative Fund of the Northeast, that don't require personal guarantees on the part of the buyers, so the member owners. They're lending to the co-op, not the individuals. So that can kind of de-risk it pretty substantially from the individual perspective versus the, say, single manager who needs to put a personal guarantee and put their house on the line and things like that. And then in some cases, especially for consumer-facing businesses, raising capital from the broader community is an option where they can offer debt, non-voting preferred stock, or other vehicles on concessionary terms from supportive folks who are interested in making a social investment or like the product and want to help out. That can look like a small sort of friends and family type raise, or it can look like a big public equity crowdfunding raise that kind of has a marketing component as well as a financial component. The second model here is the employee stock ownership plan, which are based on a RISA qualified retirement plan, so similar to a 401k, which means that they have some pretty significant tax advantages. So if it's an S corp and it's wholly owned by the ESOP, then it doesn't pay any income tax because it's a pass-through entity. The beneficiaries eventually will pay tax on their retirement plan distributions, but from a cash flow perspective, it has some pretty significant advantages for the company. Unlike the co-op where the employees hold the shares directly, in the case of an ESOP, the shares are allocated to employees but held in the retirement plan trust. And so the trustee is kind of a key linchpin in the governance and control of an ESOP company, where they have a strong fiduciary duty to the beneficiaries of the plan, which is overseen by the Department of Labor. And so there's kind of a different relationship where there's certain things where there might be a pass-through vote to the employees, like for the sale of the company. But for most cases, in terms of voting the shares are voted by the trustee rather than by the individual owners. And so when we're thinking about the minimum scale for something like this, there's sort of the tipping point of when does the tax benefits kind of outweigh the extra overhead that comes with having to do an annual valuation and having a plan administrator and all the things that are connected to it being a retirement plan. And so we tend to think about 20 employees, $500,000 in profitability to be able to kind of service the debt necessary to sort of make a leverage transaction happen is the baseline. There's certain cases where you can go smaller, but you have to look at the possible deal closely to see if that would work. Another key difference is that in an ESOP, the employees don't actually put any of their own cash down, right? They receive ownership as a benefit. The company makes these pre-tax retirement plan contributions that are used to buy shares. And so the company is essentially buying the stock for the employees, and they build up increasing amounts of ownership over time. It's something where it can be done fairly flexibly. You can do something that's a contributory ESOP where in years where the company's doing well, it makes essentially like a bonus and gradually builds ownership, or it can be done all at once through a leveraged transaction. We tend to see the latter a lot more frequently because of the tax advantages of that S Corp ESOP, but there's certainly diversity of approaches that can be taken on that front depending on how you want to go, or say if there's one partner who needs to be bought out, but the other folks want to stay in, the ESOP can be a mechanism for liquidity for one owner amongst a group of owners. And so beyond that S Corp tax advantage, there's also the tax advantage for the selling owner, which is in many cases an owner can take what's called the 1042 rollover, which allows them to take the proceeds of the sale, and if they reinvest it in certain types of investments that there's a clear IRS definition for, then they can defer paying capital gains taxes on the sale until those investments in turn are liquidated or pass into their estate on a stepped up basis. So for folks retiring and kind of thinking about estate planning, there can be a significant benefit to the point where even a lower price paid by the ESOP could yield more after-tax funds than a higher price sold to another kind of buyer. So when thinking about ESOP, there's a few considerations. Right, one is the costs. It's going to be usually low six figures to set up and low five figures kind of for ongoing annual costs to maintain. So there's that trade-off balance between tax benefit and cost that needs to be considered. The employee base, usually you want to see something that has a solid company culture that's collaborative and that can be built on to build this sense of ownership, literal ownership. It certainly is a more complex transaction than something like, worker co-op in terms of the types of professionals needed to be done and the type of valuation required and other things like that. But there is a community of practitioners who are fairly expert at it. It is regulated, right? It's overseen as a pension plan by the Department of Labor and also by the IRS. So, making sure that you have the expertise there to dot I's and cross T's to make sure you're in compliance with that front. And then, cash flow, right? And that profitability is really important. That, usually it's the company's using debt capacity to purchase the business. So there's going to be a period of time where there's a significant amount of leverage on the company, and there needs to be the sufficient financial performance to be able to sustain that. And then the final model here, and this is really particularly for business owners for whom kind of legacy and independence are a particular value for them as they think about this process, is that the employee ownership trust. So this is a version of what's called a perpetual purpose trust. There are a lot of purposes that this model can be put towards, but in the context of this, the purpose is to benefit current and future employees. Because it's not connected to a retirement plan, it doesn't have the tax benefits, but also doesn't have a lot of the costs. So the cost of setting one up is significantly lower than setting up an ESOP, probably low 5 figures. It also doesn't have this kind of repurchase obligation element that with the ESOP, as folks build up their shares and the value grows, the company needs to manage its cash flow to be able to buy those shares back. So it's essentially buying itself on a almost revolving basis as folks leave and new folks come in, right? With employee ownership trust, the shares are permanently held by the trust. So in the UK, where these are very common, the term is naked in, naked out. So the employees basically don't have any ownership of shares coming in. While they work for the company, they basically receive a share of the profit that the company generates. But when they leave, there's nothing that needs to be bought out for them. So it's only benefiting employees while they're at the company, which means that that cash flow question for ESOPs and to a lesser extent for worker co-ops in terms of buying out the accumulated share of the employees is less of a financial issue. And governance and management for these, there's a lot of flexibility, whereas ESOPs and co-ops have very specific boundaries around which governance needs to be designed. This can be anything from trustees only elected by the employees, or a seat set aside for a family member of the founders in perpetuity, or a seat for a nonprofit that is a guardian of the mission of the company, or things like that. So there's a lot of diversity in terms of what can be done. And because it's a much newer model, it's something where usually when we're seeing interest in these, it's going to be primarily seller financed beyond, things that can be collateralized. It's something that small companies or large companies can adopt. And it is possible to do a partial sale, although there are some tax complications that come with how, say, distributions for covering taxes or other things work with the trust being one owner among several.